The gold market is historically undervalued, and at the same time the shiny yellow metal has provided investors with a crash protection insurance and an inflationary protection insurance for thousands of years. In this video, I'll go through the reasons why I'm buying gold, and I'll show you who else is buying gold, and at the later end of the video, I'll show you exactly how undervalued the gold market is and how much profit can be made. As always said with educational purposes, and nothing is meant as financial advice. Ever since ancient Roman times, and even before that, gold has been used as a protection in times of wars, inflation, market panics, and other situations alike. And thousands of years later, nothing has changed. Gold has always been looked upon as proper money due to the fact it cannot be manipulated like fiat currencies. But over the last 100 years, slowly but steadily, each country removed their gold standards due to the fact it is easier this way for governments to print currency and for politicians to make promises they cannot keep, unless new currency is printed. Actually, the difference between currency and money is that money should not deteriorate in value over the long term. Currency always loses value over the long term, as it is very easy to create more of that currency, which pushes its value downwards. The counter-cyclicality of gold offers very good protection against stock market crashes. Over the last 15 serious market meltdowns, gold has performed well in all except one of the 15. The one exception is during the stock market crash between 1980 and 1982, when the S&P 500 index fell by 27.27%, while gold fell by 45.78%. This is due to the fact that in 1980, gold reached its bull market peak, as from 1971 until 1980 it went from $35 all the way up to $850. During the biggest crash in stock market history, the Great Depression, between 1929 and 1932, stocks fell by the astonishing 86.19%. while gold had a positive return of 0.29%. So in relation to stocks, gold outperformed by the astonishing 86.48%, establishing itself as a true safe haven asset of the time. During the most recent biggest crash of this decade from 2007 until 2009, stocks fell by 57%, while gold went up by 25%, so again in relation to stocks, gold outperformed by 83%. Gold does not always have a positive return when the market is falling, but most of the time it outperforms it, and in relative terms the returns are exceptional. This is a major reason why Ray Dalio, one of the greats of the investing world, likes gold so much. And this is why it has a 7.5% share in his infamous all-weather portfolio, which over the last several decades never had a down year. And the returns of this portfolio are on par with the S&P 500 return, with a slight detail that the volatility is much lower. The current strength of the US dollar is a main reason why in dollar terms gold is not performing the best in the current inflationary environment. Make sure to watch my analysis on the dollar milkshake theory here on the channel, where I explain why the dollar is rising the way it is currently. But in all other major currencies except the US dollar, gold is performing quite well, as we can see on the provided chart. In Canadian dollars, gold is pretty much flat. In Aussie dollars, gold is up by 2.9%. In euro terms, gold is up by 5.3%. In UK pounds, gold is up by 10%. In New Zealand dollars, gold is up even more than 10%. While at the same time, all stock markets in these countries have lost values. Sooner or later, gold will rise in dollar terms as well. Now that we know why gold is a good buy during the current economic environment, let's see whether gold purchases are increasing or decreasing overall. The next chart is showing the COMEX gold deliveries. And as we can clearly see, ever since 2020, the purchases of gold have skyrocketed. These purchases are for physical gold, and a major reason for the uptick is that from 2020 onwards, central banks started to print massive amounts of currency, which is a good catalyst for gold. The following chart shows the non-physical purchases of gold done through gold ETFs. The current buys are again at historic highs. In general, I would not buy a gold ETF. I would always buy physical gold as it offers a potentially higher return due to the fact that when prices are rising, physical gold coins and bars are selling for a premium over the spot price. And with an ETF, we do not have these premiums. Another reason is physical gold offers decentralization from the financial system, while ETFs do not offer this. Let's now discuss whether gold is over or undervalued from several different angles. First, we must ask the question, is gold at an all-time high in nominal and real terms? Real terms means on an inflation-adjusted basis. On the next chart, we can see exactly this. In the summer of 2020, gold reached its nominal all-time high of around $2,070 per ounce. But in real terms, the all-time high was reached in 1980, when gold was standing at $2,486. So the current price of about $1,650 is about 50% below its inflation-adjusted all-time high. Another very important metric to look out for is whether gold is over or undervalued in relation to the US stock market. We can either use the Dow Jones Index or the S&P 500 Index for our analysis, and I'll show you both. The first chart is showing the Dow Gold ratio, which has a longer data history. The current level sits at about 18, while the average for the last 120 years is about 8. This means that either the Dow needs to fall by 50% and gold must remain flat, or gold needs to go up 100% in order to reach its average level, and the third option is for the Dow to fall and gold to rise. The next chart shows the S&P 500 against gold. The data history here is shorter as the S&P 500 did not exist prior to about 70 years ago. The average level for this period is about 1.2, while the current level is sitting at about 2.1. Or in other words, gold is again severely underpriced. The biggest undervaluation for gold against the stock market was seen in 1999 and the early 2000s, when gold was near the bottom of its 20-year bear market, while the stock market was at the top of its bull market during the dot-com bubble. Now, if we flip the chart, we see the gold to equity ratio over the last 120 years. And when we look at this, it is quite clear we are near the all-time bottoms of the market. To conclude, gold has the longest history out of any asset when it comes to crisis protection and profit making. The greatest investors in the world like it and believe in it, and the current low prices of gold offer tremendous opportunity when it comes to wealth protection and wealth building. So make sure to subscribe to our channel if you're interested in gold investing, and comment down below what analysis you want me to do next. Hit the bell icon to make sure you don't miss out any of my future videos, and I'll see you next time.